Welcome to today's episode of the Simply Financial Podcast. This is Christopher Calandra. Want to increase your financial IQ with today's episode. When you get something in the mail and it says your federal tax return has been selected for examination, that means you are up for an IRS audit. It is one of the prototypical oh crap moments. It really brings home that you're an American citizen. It's scary, although it doesn't have to be. It is time consuming though. You might owe more taxes, and because you might have underpaid your taxes previously, you might be looking at interest and penalties. None of this is very good. Please note that the higher your income, the higher it is for a potential audit. Audit rates are higher as you climb the income ladder. I know I was audited a few years ago, and it was a stressful experience. They asked for a lot of information. It was during COVID, so it was a especially weird process. Fortunately, Joelle and I, my wife and I, were successful, and we didn't owe any additional money. We were successful in getting them everything they wanted, and we had a happy ending. But it did take a lot of work to get everything to them. So according to Schwab, there are they identified the top 5 audit triggers. I want to share them with you, talk a little bit about them. The first one is missing income. Understand that any income you get is reportable to the IRS, and they cross-reference this with reporting they get from various institutions. And when they don't match up, when the IRS believes that there might be missing income, that is likely to trigger an audit. You want to make sure you submit with your tax returns all of your W-2s, as well as all of your other income, which is a very broad category. There are lots of examples of income: alimony, capital gains, dividends, interest from bank accounts or investments, rental income, Social Security. The list goes on and on and on. You want to make sure when preparing taxes is to make sure you include all of your income. If you give to your CPA only a partial list of your income, that is what they will report, and you are set up for the top audit trigger. You want to avoid that. Be aware of all your income and report all of your income. Number 2 is large swings in income. The IRS views that as a potential situation where there's underreporting of income. This is really problematic for entrepreneurs, especially because when you own a business, income swings, unfortunately, are often part of the equation. It also happens with individuals who might have a sales job and get some tremendous incentives only for the following year things to turn around in a negative way. So if you think back over the last 5 or 10 years of your income, you've probably had large swings. Those large swings, unfortunately, do increase your likelihood of an audit. So that's number 2. Number 3 is business losses. I mentioned small business owners and entrepreneurs a moment ago. If you have a business, whether it's your primary income source or a side hustle, part-time business, if you have a business that posts losses year after year, you're going to attract audit attention. Granted, in the first few years of a business's formation, that's not true. There is generally an expectation when you start a business, there might be losses in the early years as you gear up, have expenses, but don't necessarily have the revenue. So early years are excusable. But if you have a business that posts losses year after year, you're increasing the likelihood of an audit. Now, there may be good reasons for this. It doesn't mean that the audit means that you will owe taxes, penalties, and interest, but be aware that it'll get attention from the IRS, unwanted attention from the IRS. Understand, if you're not a small business owner and you don't have business losses or business income, is when you have losses, you could write that off against other income. So there are some unscrupulous people that'll use this to their advantage and in the wrong way reduce their tax liability. So that's number 3, business losses. Number 4 is questionable deductions. If you're taking deductions on your tax return and they are out of the norm, they are going to garner unwanted attention. Part of the benefits of working with a tax professional, I work with a CPA and have done so my entire adult life, is that they could help guide you on this subject because they often know where the red flag areas are. But I'll give you a few examples. This is not an exhaustive list, but just to give you a couple of 4 instances. Outsized charitable contributions. If you're giving a lot of money to charity and it's not easily trackable because it's local charity or you're gifting property to charity, that might be viewed as a questionable deduction. Passive losses on rental property. For my real estate investors out there, there's lots of good reasons to build wealth through real estate investing. Passive losses on rental property are a good example of questionable deductions that might increase the odds of an audit. Home office, an unqualified home office. Know that if you have a home office, you could deduct that square footage in your home and a pro rata portion of the household expenses like electricity and so on, you could deduct. The IRS generally, and this has been forever and a day, they look very questioning at home office deductions. I grant you, in today's world in 2025, people working from home and having home offices is way more common than it used to be. It still remains, though, a questionable deduction and might increase odds of an audit. And the last one won't apply to a lot of people, but number 5, and the last one on the list I got from Schwab, is when filing an estate tax return. Someone passes away, you have to file an estate tax return. And part of that process is to list all of the assets and the debts of the estate. And it can be the case where you would undervalue assets. If there's a home of the deceased that's going to family, if you're not selling the home, who's going to determine what the value of the home is? And there might be an inclination on some to undervalue the home, make the assets look smaller to perhaps avoid some probate and or estate taxes. Same thing for cars of the deceased, personal property, jewelry, art, things like that, furniture. If they own a business and they're passing the businesses on to their heirs, how do you value that business? That is the 5th, and it makes sense, although it might be a more narrow target audience for this audit flag, but that's the 5th one. Before I wrap up, let me point out that there are generally 3 types of IRS audits. The first one is a correspondence audit. It's basically through the mail. It's by far the most common. They send you a letter. They are asking for documentation, verification. They might say you have to pay by this date. There might be interest and penalties. Maybe they're right and you just pay it, or maybe you want to push back and tell them that they're wrong and explain why. But correspondence audit, the most popular through the mail. The second one is office. You go to the IRS office. Nobody wants to do that, but they would ask you to come in with a list of things that they want to review with you. You'll have to bring your documentation. I believe you could send your CPA or tax professional to go on your behalf. And then the last one is a field audit. And that is when they come to you. That's what you see on TV and in the movies, the most scary version. The IRS person comes and makes your life a living, I can't say the word, but you know what I mean. They'll come to you. This is the most comprehensive audit, a field audit. It's also the least likely to happen. It's the smallest percentage of all audits. So those are the 3 types of audits. So if you get audited, it's not the end of the world, but I do recognize, having gone through it myself, it is stressful, it is time consuming, it is no fun. But you might occasionally get an audit, especially if your income is high or if you fall into one of these 5 audit triggers. These 5 audit red flags do not automatically mean you did something wrong. It just means they may want to check into it. In my case, the one audit I ever had was a comprehensive audit. Again, it was different because it was COVID, but it was sort of a field version of an audit, although everything was done through the mail because of the COVID restrictions and such. But even though they asked for a lot and it was stressful, we got a clean bill of health. We did not owe any money. We got them all the documentation they wanted, and it was a happy ending. So fear not should you get something from the IRS about one of these three types of audits. Thanks for listening today. I appreciate you checking out the show. Please subscribe to the Simply Financial podcast if you haven't done so already, and I'll be back with you on the next episode of the Simply Financial podcast very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.